This is Al Brooks. Thank you for watching the Brooks Trading course. This is the third of 5 videos on breakouts. I'm going to be talking about one of the important characteristics of a strong breakout, and that is that there usually is at least a second leg. Sometimes there is more. Finally, I'll talk about trading range breakouts, successful trading range breakouts. Look at this chart. Here we have a series of bear bars. It's a bear flag. Odds are the breakout will be to the downside, so traders will sell below the low of the prior bar. They'll sell with a stop below that bar. They'll sell at the market, betting that the bull reversal attempt will fail. If you have a bear trend and then a small pullback like this, a bear flag, the probability is you get the bear breakout. So if you get a bull breakout, that's a surprise. It's a low probability event. And here we're getting the bull breakout. Traders expected the opposite. They expected a bear breakout, and instead they got a bull breakout. So traders are trapped in and out. Bears are trapped in. They've been selling here, betting on a second leg down. And bulls were trapped out. It was a low probability buy, so they did not buy above the highs of these bars. And look at the bull bodies. Small, smaller, non-existent. So they were not even buying closes. Yet we got the bull breakout. Bears are trapped into a bad trade. Bulls are trapped out of a good rally. Both are hoping for any kind of a pullback to buy. The bears want to pull back so they can buy back their losing shorts with a smaller loss. The bulls want a pullback because they see this as a surprise, a low probability event. They know there are trapped traders. They expect the market to go higher at least a little bit, so they're hoping for any kind of a pullback to buy. And because both bulls and bears are hoping for any kind of a pullback, if there is a pullback, both bulls and bears will buy it and we'll get a second leg up. A surprise means low probability. We're getting a bull breakout above a bear flag. And it's a pretty weak looking rally. So this is a pretty good bear flag. The odds were that the market was going to break to the downside. In any trade where one side has low probability, that side usually also has high risk reward. The bulls had a low probability bet that we'd get the bull breakout. Because it's a low probability bet, it has good risk reward. And that means either small risk or big reward. Big reward usually means at least a second leg up. Many bulls will not buy here. They'll wait until the market breaks above some kind of a major lower high. Like, for example, the high of that bar. And again, as I said, the bears were selling all of these bars, betting on a resumption of the bear trend. And they even sold early on in this bar, betting that it would be like these and the bulls would fail and we'd get a bear breakout. Some bears will even sell this close, betting that the bulls need one more bar, and chances are reversals fail and the bulls will not get their one more bar. So you'll get some bears not only selling as this bar formed, some will wait for the close and say, I got trapped bulls thinking that they're going to get a successful breakout. Therefore, I'm going to sell this strong bull close, betting that the bulls will not get good follow through. My risk is not big. I sell this close. I risk to just above this bar, and it's a reasonable trade. I'm risking very little. At this point, the probability is that the market is going higher, but some bears will take that short. Bull breakout. The bulls really need one more bar, maybe 2 more bars. We have a bear channel, and we got a bull breakout above the bear channel. We have a bear flag. We have a bull breakout above the bear flag. And now we have a major lower high. I say that. Let's just assume that we're in a bear trend. We pull back, and it's a major lower high, a strong breakout to a new low. And now we have a breakout above that major lower high. We have a pair of consecutive good bull bars. Some bulls will buy the close of this bar. Other bulls will buy on a stop above there. Bears will buy on a stop above here. Some bulls will say, well, it's consecutive bull bars, but only one bar is breaking above a major lower high. I need one more bull body. And as small as this bull body is, that is enough for traders to believe the probability is high that we're going to go up higher. So even though big tail on top, small bull body. It's a bull body and not a bear body. That is good follow-through buying, and it increases the probability that the market will go higher. For some bulls, this is the breakout, a breakout of a bear channel and a bear flag. For other bulls, this is a more important breakout because it went above a major lower high. Some bulls will see this as the follow-through from that breakout. Other bulls will see this as the follow-through from this 2-bar breakout above this lower high. Both are high probability buys, and this is what happened. So first leg up and pullback, sideways pullback. We could not even pull back below the low of the prior bar. Traders were so eager to buy, both bulls and bears. Remember, bears are trapped into shorts, and at some point they conclude, it's not going down, I gotta buy. And the bears give up. And bulls are trapped out of longs, and they decide at some point that it's not going down, I better start buying with stops, maybe above the highs of these bars and this bar, or as this bar goes up above this bar, just buy. Traders decide that the price is wrong. No one wants to sell here, and it has to go up higher to find where there might be sellers. I call this a pullback. A pullback is any pause in a bull trend. Technically, this is a pullback. This bar fell below that bar's low, but this is a type of pullback as well. It's an II bull flag. We have a bull trend, we're always in long, and we went sideways in a pair of inside bars. It's a pullback, it's a bull flag. Look at the low of this bar. Traders saw this, they wanted to buy any pullback. They placed a limit order to buy at the low of this bar. Did not get filled. They placed a limit order to buy at the low of this bar. Did not get filled. So all of those traders who were so eager to buy a pullback are not getting into the market. Most of them are not getting filled with their limit orders. And at some point they say, it's going up. I'm just going to buy at the market. And you start to get that second leg up. So leg one, pullback. Leg two. After any kind of breakout with follow through, the minimum goal is a second leg up. As I said, sometimes you get a third, fourth, or fifth leg up, but the minimum goal is a second leg up. We got a bull breakout, and now we're starting to form a channel. A tight channel like this is a breakout on a higher time frame chart. So this is still a strong bull trend. Yes, we have a second leg up, but it's probably continuing higher because a tight channel like this is usually a breakout on a higher time frame chart. So yes, 2 legs up, 1 pullback, 2 on a higher time frame chart. This is still part of leg 1, and we don't know where leg 1 ends. Whenever you do have a leg 1 move, you always think about, well, maybe we'll get a leg 1, leg 2 move. Maybe leg 1, pullback, and then leg 2, measured move up. Strong enough breakout here. First leg up, second leg up. Second leg up has strong breakout and decent follow through. So there may be a second leg up after this second leg up. In other words, a third leg up. So it's a strong enough breakout. More traders are trapped. Bulls are trapped out, bears are trapped in. Chances are we're going up at least a little bit more. Another strong breakout, probably strong enough for at least a second leg up. Breakout, pullback, second leg up. Sometimes breakouts are a single bar. Sometimes they're 2, 3, 4, 5, 10 bars. Sometimes you get one breakout and then a second leg up, and that's the end of it. You enter a trading range or even a bear trend. Sometimes you get a series of breakouts, breakout, pullback, breakout, pullback, breakout, 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 breakout. Now, sometimes you can get a very strong second leg. Here we have an okay bear breakout. Any trend bar is a breakout. Any series of trend bars is a breakout. Bars closing near their lows having decent sized bodies increase the probability that the first pullback will be sold and you get a second leg down. And sometimes the second leg down is very strong, especially if it's in a trading range, and it becomes a second leg trap. So if this were a trading range or a broad bull channel, and I see a strong second leg down like that, I'm assuming it's a second leg trap and it's the end of the move and not a measuring gap. So more likely an exhaustion gap, and the gap between this close and that low will close, and the market would either go sideways or even up. Strong bear breakout. Is it strong enough so that the odds are there'll be at least a second leg? Yes. Now, second leg does not necessarily mean second leg to a new low. Sometimes you get a breakout and the second leg does not fall below the low of the first leg. This might be the second leg, this might be the second leg, this might be the second leg. Sometimes the second leg down can form a higher low. Second leg down, it can be simply a single bar. Here we got a bull breakout of a bear flag. So we got either one leg up, pull back, two legs up, and we got a bull breakout above a double top. You can say one leg up, two legs up. So it could be a large bear flag. But in any case, we got a double top bear flag here, and we have a decent bull breakout, but look at the follow through. A terrible follow through bar. So you get disappointed bulls who bought that close, and now they're hoping for the market to get back to that close so they can sell out of their lungs. And that's what they did here and here. A lot of bulls who bought this close or bought the breakout decided this is disappointing. I better get out break even. I'm going to place a limit order to sell on that close. And when it got back to the close, they sold. Strong enough bull breakout, the market's probably not going to go straight down. Strong enough bull breakout so that there will be some buyers on a reversal attempt and we'll get a second leg up. Again, sometimes the second leg up does not get above the top of the first leg up. And sometimes the second leg up is simply a single bar. Wedge bear flag, tried to get a bear breakout, and it reversed up and we got a bull breakout. Double top, instead of a downside breakout, we got a bull breakout. Second leg up, a problem. It's basically an II or an III pattern, micro double top, and this is a possible micro double top and a failed breakout. Higher probability to sell below this bar, betting on a failed bull breakout. The bulls tried to get up here, they had a second bar up here, and then this bar tells me that a lot of the bulls who bought here used this bar to get out break even, and the bulls are giving up. So we got a micro double top and a failed breakout above a wedge bear flag. Bulls will give up, and here the bulls did give up, and bears will short either below this bar, below these three bars, or below this bar. This is where traders mostly sold. Second leg, a lot of times it's not clear, and a lot of times you need to wait and you need more bars to get clarity. Different computers will use different counts. So strong bull breakout, pretty bad follow through, but still strong enough bull breakout for a second leg up. Is this the second leg up? Some computers will say this is it. We went sideways. We're trying to go up again. Is this the second leg up? Again, some computers will say that's the second leg up and we failed. Others will say this is the second leg up. Others will wait and say we'll probably get an even stronger second leg up. And here we did get an obvious second leg up. So at this point, maybe this is the second leg up. At this point, maybe it's the second leg up to a micro double top. Bears are trying to break to the downside. Bear breakout, bad follow through from these two bars. We got a clear second leg up. At this point, we have a big bull breakout bar, clearly a second leg up, comparable in strength to this, maybe leg one, pull back, leg two, and then terrible follow through. The minimum requirement has been met. Strong enough to get a second leg up, we got a second leg up. Strong enough to get a measured move up, we got leg one, pull back, leg two. So the bulls are satisfied, they got their goal. And then we got this bad follow through bar. A lot of traders will sell that, betting that we have the second leg up. Some traders will say, well, isn't this strong enough for another second leg up? It might be, but I certainly would not buy at the low of this bar. The only thing I would do at the low of this bar is either get out of longs or go short. Bear breakout. We have a bear breakout here, probably second leg down. This might be the second leg down. This is the euro versus the dollar, 60-minute chart. Maybe this breakout is strong enough so that we get even further down. Maybe because this channel is so tight, I don't know if it's a micro channel, this might be a little pullback, but in any case, it's a pretty tight bear channel. It's a breakout on a higher time frame chart, so any pullback that we get probably will be followed by a second leg down. So strong bear breakout, 60% chance of a second leg down, 40% chance it'll fail and we will reverse up. Big bear bar, consecutive bear bars, the bulls are giving up. So all the bulls who are buying in here, hoping for a reversal, maybe higher low, major trend reversal, they gave up here. This is a minor reversal. You're getting the first breakout above a tight bear channel. Probably the best the bulls get is a bull leg that becomes a bear flag. Here, not enough bars for a major reversal. So again, minor reversal, which means odds are we're going lower. And here, both bulls and bears sold. The bulls sold out of their longs, giving up, and the bears sold, betting on resumption of the trend down. Same true here. very strong bear breakout, possibly an exhaustive end of the move. Whenever you have a strong bear breakout occurring 20 or more bars into a trend, it's more likely to be an exhaustion gap, and that's what we have here. The biggest pair of bear bars in the entire sell-off occurring maybe 50 bars into the trend, more likely exhaustion gap between this close and this low, this close and that low, this close and that low. Chances are we're going to go to the top of the sell climax, or at least a little bit above it, and get two legs up, one, pull back, two. But sell climax does not mean reversal into bull trend. It just means the bears are exhausted and they'll wait 5 or 10 or more bars before they're willing to sell again. They usually wait until the market tests the top of the sell climax. It tried to break above it here, 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 kept failing, and then at some point here, everyone sold. The bulls gave up and the bears sold. Another big sell climax, consecutive sell climaxes, here, 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 bigger, here, even bigger still. So probably we'll get some kind of significant bounce soon. Each one of these bear breakouts, bulls are giving up. The bulls who are hoping for a bottom, they're giving up. Bulls tried to bottom here, minor, tried to bottom here, minor, tried to bottom here. Maybe a higher low, major trend reversal, major trend reversal. Probably not enough buying pressure. So even this is probably a minor higher low. And every one of the reversal attempts failed. A lot of times when you're in a channel and the market becomes always in long, like it probably was somewhere in here, it's probably a broad bear channel. Broad bear channels typically have times within the channel that the market is always in long, but the market continues to make lower highs and lower lows. So here, this is a test of the top of this final bear leg, and it became a double top bear flag. Here's the neckline, broke below the neckline. Pretty impressive sell climax, probably an exhaustive sell climax, and we got to the top of the sell climax. And then here we have another even stronger sell climax, an even bigger bear bar than any of the bars in the past 100 bars. So the odds are it's going to be a sell climax, an exhaustion gap, rather than a measuring gap. So it's possible that we get a measure move down from there. More likely the gap will close. By close, typically you get to the top of the sell climax bar, you get to the top of the sell climax leg, and then you enter a trading range. Sometimes you get a bull trend. Bull channel, bear flag. Bull channel or trading range, bear flag. Stronger bull channel, but still bear flag. Little triangle, bear flag. Got a bull breakout and then a bear breakout. Every attempt to rally, the bears see all of these attempts as bear flags. And so they're looking to sell a bear breakout below the bear flag, so they can sell with stops on the reversal back down. Some bears will sell above bull bars, betting that the reversal up is minor, but bears are selling all the way up, and that's why the rallies look so weak. Where are the consecutive big bull trend bars? They do not exist because the bulls are not strong enough, and all of these reversals are minor. Minor means at best a bull leg in a trading range, and the odds are that we'll have at least one more leg down. So I want to talk about breakouts in trading ranges and breakout attempts in trading ranges and successful breakouts in trading ranges. Clearly a trading range. Everyone knows, I always talk about my 80% rule. 80% of the time when the market's in a trading range, strong breakouts fail, or all breakouts fail no matter how strong. So good bull breakout, reverse down, good bull breakout, reverse down. Bears trying to break out and they're failing. And after a trading range goes on for 20 or more bars, the probability of a bull breakout becomes the same as for a bear breakout. Before the trading range, we were in a bear trend, and early on, it was more likely we would get the downside breakout, but after 20 or more bars, the probability becomes about the same. Traders know that all through here. Once you decide after 20 or so bars, it's a trading range, traders will bet against breakouts. They'll sell bull closes near the top, they'll buy bear closes near the bottom, they'll buy reversals up near the bottom, they'll sell reversals down near the top, and they scalp. They take quick profits because they know the odds are breakouts will not be successful, so they're scalping. Bulls and bears are buying low. Bears are buying low to buy back their shorts. Both are selling high. Bulls are selling high to sell out of their longs. But both know that because of the market cycle, the market's either in a trend or a trading range. And if it's in a trend, eventually it becomes a trading range. If it's in a trading range, eventually it becomes a trend. Trading range traders keep buying low, selling high, and scalping, knowing that eventually there'll be a successful breakout and they might lose. But if they take enough trades in here, profitable trades in here, they're hoping to make enough money so that it more than offsets the final losing trade. Bulls buy in the bottom third, scale in lower, scalp out. And bears sell in the top third, scale in higher, confident that the bull breakouts will fail. And eventually there is a successful breakout. But at this point, it's 50-50 bet. Will it be up or down? This is a pretty big bear bar. You can say, well, Al, it's a big bear bar and it's 60 or 70 bars into a trend. Isn't that an exhaustion bar instead of a measuring gap? Well, it's not really in a trend. The market was sideways for 30, 40, 50 bars. So this is probably the start of a bear trend. The bigger the bar is, the more likely the bears will get follow-through selling. The more it closes on its low, instead of having a big tail on the bottom, the more likely it'll lead to a leg down. And the more this close is below the trading range, the more likely will go down. And the more bars that this bar closes below, the more likely we're going to go down. So this has everything going for it. A big bar, closing on its low, closing below the trading range, closing far below the trading range, closing below the lows of the past 50 or 60 bars. So probably going to be some kind of a measuring gap. Bulls were buying low. They're also buying below bars. Below this bar, the bulls will buy. Below this bar, bulls will buy. Below this bar, bulls will buy. As soon as this bar closes, they place a limit order to buy that low, and they get this. But if you're a bull and you got long right here as the market fell below that low, what do? At this point, you know it's probably a measuring gap and that we're going lower. So you got to sell out of your longs. You can either do it immediately or you can wait for any kind of a pullback. But if you wait for a pullback and you're selling, you know the bears are going to sell as well. There are some bears who did not sell this breakout. It's a surprise. They're waiting for a pullback to sell. So both bulls and bears are waiting for a pullback to sell. What does that mean? It means that whenever this leg ends and we get a pullback, probably bulls and bears will sell the pullback and we'll get at least one more leg down. Okay, a pause. The bears, after their breakout, got their minimum, the absence of a bull bar. The bulls have a bull bar here, but chances are this is enough follow through this bar and that bar so that there are more sellers above this bull bar than there are buyers. Both bulls and bears will use this little reversal attempt to sell. Bears will sell into new shorts, the bears who did not yet sell, and bulls will sell to get out of their losing longs. It does not matter if you sold here or here. Your stop is still up here at the top of the bear leg. Maybe you can put it above the top of this sell climax or above the top of this. This is the start of where the market clearly became bearish. But in any case, you got to put a stop fairly far up. And what does that tell you? Risk, reward, probability, right? So your stop is far, so your risk is greater. Also, you're fairly far into the trend, so there's less reward. So selling anywhere in here has bad risk reward. When you have bad risk reward, you know you have good probability. So the probability is we're falling more. Let's say you sold anywhere in here and you say, gosh, my stop is way up there. I don't want to risk that much. And a lot of the computers that did short through here decide that the risk is too great. And when the risk is great, they have to reduce their risk. The easiest way is to take profits. And when the computers or traders take profits on profitable shorts, they get a little reversal attempt. This is not so much due to aggressive bulls buying as it is to bears looking at their stop being so far away that their risk is now big. It does not matter where you sold. If you sold here, if you sold here, if you're still short, that's your risk. So your entry price has nothing to do with it. All that matters is where your stop is. Wherever you entered, irrelevant. If you're still short down here, that's your risk. That's how much money you're risking. And a lot of bears will buy back some of their shorts and it creates that little pullback. A lot of times when there's a little pullback like that, the bears will wait a few bars to make sure the bulls do not get a micro double bottom and a big reversal. So a lot of times you go sideways for several bars after the profit taking, but the probability still is that the market will go lower. Let's say a bull does not buy back his long here. Maybe he's thinking, we should get higher up. We should overlap that low, maybe get up to the top of the sell climax. Some bulls want a higher pullback to exit with a smaller loss. So a lot of bulls will wait to sell out of their losing longs. And sometimes the bears will wait as well, thinking, maybe this does not look like particularly good follow-through, tight trading range. Maybe we will go up a little bit. Well, I'm going to wait a few bars before I sell because I'd like to sell higher, and I'll give it a few bars to see if it'll go higher. And if it does not, and instead it starts to go down, I'll sell the breakout, the downside breakout. Bears are giving a chance to the bulls. Okay, bulls, how strong can you be? Are you going to be able to turn the market up a little bit? And if you do, then I get to sell at a higher price. So you have bears wanting to sell and waiting to sell, waiting to see if they can get to sell higher. They're going to sell either way, but a lot of times after a little bit of profit taking like this, the bears wait to see if the bulls can lift the market higher, and then they sell. Bears see the bulls having a micro double bottom, but tight trading range. And is this the second leg down? Is it leg 1, pullback leg 2? Or are traders still betting that this is going to be a measuring gap and that will fall for a measured move down? I think the probability still favors the bears. Bulls see a micro double bottom, hoping that we'll get a higher bounce. But a lot of the bulls will use any minor reversal like this to sell out of their longs. And they'll give up, and we might get another breakout bar to the downside. The bears sell, knowing that the bulls will use any kind of a bounce to sell. Bears know that the bulls probably will wait many more bars before they buy again. If the market starts to go down after this attempt at a bottom, the bears know the bulls will probably wait 3, 4, 5, 6 bars before they buy again. So we can get vacuumed down pretty quickly, creating a very strong second leg down. And because of that, bears will sell, knowing that there are not enough bulls at this price. The market has to go lower to find a price where bulls will be willing to buy. So bears sell, and you get a breakout bar, a bear breakout. The bulls who bought in here are giving up. The bears who wanted to sell higher decided that it's not going higher, so they sold here. Trading range. This range might be too tight to trade, but if a person were trading it, they want to buy in the bottom third and sell in the top third. Bulls and bears. Bulls buy in the bottom third, hoping for a scalp up, and then they sell in the top third, take profits. Bears sell in the top third, hoping for a scalp down. When it gets to the bottom third, they buy to take profits. And both are willing to scale in. Everyone knows eventually there's going to be a successful breakout. After 20 or 30 bars in a trading range, the probability of a bull breakout is the same as the probability of a bear breakout. And they hope to make enough money scalping, especially with limit orders and scaling in during the trading range, so that when the breakout finally comes and they finally lose, they'll have enough winnings to more than offset that loss. Again, when a range is this tight, I think most traders should not trade. This is the dollar versus the yen. Bulls buy near the bottom, confident the bear breakout will fail. Bears sell near the top, confident the bull breakout will fail. And both are correct. 80% of all breakouts fail, so traders are willing to buy low, sell high, and scalp. Other traders, most traders when the range is this tight, most traders should wait for the breakout and see what it looks like. Early in the breakout, bears will sell the bull close at the top of the range, betting it will fail. But now we have a bull breakout, closing on its high, closing above the top of the range, closing above the top of the past 50, 60, 70 bars. And then we have a follow-through bull bar. Tail on the top, yes, weakens the case for the bulls, but a close above the middle of the bar and a second close above the trading range. Probability is measuring gap, not exhaustion gap. So probably going up for at least a measured move based on the height of this range, so somewhere up here. And strong enough breakout so that if we try to reverse down, bulls and bears will buy. Bulls will buy, hoping to be buying low, expecting a second leg up. Bears will buy because they see a strong breakout with follow-through, knowing a second leg up is likely, so they'll buy back their shorts. A lot of bears wait for that follow-through bar here or here, and then conclude that this is just too strong. I'm going to buy at the market. And chances are we're going to get some kind of follow-through move up. This looks like buy the close, maybe starting here. Traders, every bull close, they just keep buying, betting that we're going higher for some kind of a measured move up. Every bar that gets added to it increases the profit target, because one of the profit targets is simply based upon the breakout. from the open of the first bar of the breakout to the close of the final bar of the breakout, usually you get some kind of a measured move up. Now suppose you bought below this bear bar, or above this bull bar, or even this close of this bar. Let's say you bought here. Where's your stop? For all of the traders, it's the same, below the bottom of the bull leg. Your stop has nothing to do with where you entered. It has only to do with the price action, and if you're buying on the bet that it's a swing up, it does not matter where you bought. All that matters is where the stop goes, below the bottom of the most recent higher low, so down here. At some point, traders start to get uncomfortable. They say, "Wow, gosh, my stop is way down there. I don't want to risk that much." And the computers have protective algorithms within them. So whenever the stop gets too far, they conclude the risk is too big. They have to control the risk. Easiest way to control risk is take profits. And that's why you get a pullback. Even though it's a very strong bull trend, you still get a pullback. Because at some point, too many traders, too many computers decide they have to take some profits to reduce their position size. So that profit taking creates the pullback. But it's still a bull flag. The bears who sold for any reason are hoping for a deeper pullback if they did not give up here. Most did give up here, but if they did not, they're hoping for a deeper pullback that would allow them to exit with a smaller loss. Some bears selling up here, and they need a deeper pullback to make a profit. So bears are looking to buy. And when you get a pullback like this, a lot of times the bulls will wait 5 or 10 bars to see how low the bears can drive the market. The bulls want to buy. They'd like to buy down here, but they'll buy for any reason. And if the bears are not successful in lowering the price after about 5 or 10 bars, the bulls will just buy at the market, or they'll buy above bars with a stop, betting on a second leg up. And if the bears are not successful, all the bears who shorted in here and the bears who shorted down here and who did not get out here will give up, and that will create a second leg up. If this grows to 20 or 30 bars, then we're back in another trading range. After about 10 bars or so, bears start to buy, getting nervous that it's not going down, and they got to take their loss. And bulls begin to buy as well. Same reason. It's not going down. Odds are we're going up to some kind of a measured move. And after 5 or 10 bars, if it's not going down, I want to buy. So I'll start buying with stops or at the market. And then we got a little bit more buy the close after 3, 4, 5 bull bars. Reversal attempts probably fail. Pretty tight bull channel, not much in terms of big bear bars. So more likely these reversal attempts will fail and will continue higher. The bulls know the bears are trapped. So when it starts to go up, even though the bars are small, once you start to get 3 or 4 bull bars, the bulls know the bears will give up. So the bulls are buying, and the bears eventually do give up. Maybe that bull trend bar there. In this video, I talked about the importance of a strong breakout, because if it's strong enough, the odds are the first pullback will be followed by a second leg. And then next, I talked about successful trading range breakouts. I'm Al Brooks, and thank you for watching the Brooks Trading Course. This is the third of 5 videos on breakouts.